Here to discuss the move in the bond market and the Fed's fight against inflation is Komal Sri-Kumar, president of Sri-Kumar Global Strategy. Sri, just update us. You're still predicting 4% on the 10-year, but that's as high as it will go?
I'm predicting 4% on the 10-year, Joe. And again, I always tell you a few basis points above or below. For instance, last time we peaked out at about 425, 430. Will I be surprised if it goes to 425? No, I will not. But around 4% is still my maximum. And so anywhere at current level or around 4%, they are going to provide effective competition to equities during the months to come. And you talked about two-year treasuries. Think about what happened. As soon as Jerome Powell gave his press conference on February 1st, we were then at 4.1%, and today we are 50 basis points higher. Essentially, the market is saying they don't trust the chairman's dovish message of February 1st. They are looking for more rate hikes. The futures market no longer expects a rate cut during the rest of the year. So it's going to be one tough going for the Fed during the rest of the year, Joe, and that's the message from the market.
Yeah, the reason I was, focusing on that 4% is because, the short end of the curve is a lot higher. So people are still convinced that they're going to, go too far, and eventually that long rates deserve to be lower than short rates because there's going to be, I thought we were going to avoid a hard landing. Some people said we're even going to avoid a soft landing at this point because the labor market looks so good, Sri. So the stubbornness of the short end to stay high and the long end to not move, you think they will cut at some point at the end of this year? The market's not saying that anymore? They'll overdo it and have to cut?
I agree with all your expectations on the two-year, namely that the two-year is suggesting that the Fed will go too far. I was not one of those who ever said there will not be a crash. There was going to be a recession. I've been talking for 2 years about a stagflation, and that is still my principal expectation. Now, will there be a rate cut before the end of the year? It is going to depend on the unemployment rate surging from a 3.5%, let's say by 1 percentage point by the middle of the year or third quarter. We are approaching then the presidential elections, and something needs to be done. The pressure on the Fed will be enormous. That's one reason to cut. Second, in 2019, Joe, we stopped quantitative tightening because there was a credit crunch in the market. If that happens again, the Fed will throw in the towel and say, forget about inflation. Our job is to save the system, and we are going to go into quantitative easing mode. So that's what has kept the Fed looking increasingly at growing its balance sheet over every 10 years. It never comes down to the original level.
Could you see just a turn on a dime in the labor market? Is that possible, Sri? We had, such a strong number that really scared the markets a couple of weeks ago. But, okay, so we reopened. Everyone wants to travel. Everyone wants to go to restaurants. They weren't staffed completely. So I understand what's happening right now. But the expression, things happen gradually and then it happens all at once.